Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. On this weekend show, we're going to start off first half of the show looking at some of the recent economic data and even potential news out of China when they all return from their golden week, as well as talk a little bit about the markets, S&P over 5,800, and look ahead to next week with a key central bank meeting. On the back half of the show, we're then going to switch over more to the resource space and talk about the investing environment around critical minerals. It's going to be a good show for all of you and all of us recording it. Always fun to bring on some of our thought leaders to get their recaps of what happened in this last week and look ahead to the weeks and months ahead. To kick off this show, we are chatting with Marc Chandler, managing partner at Bannockburn Global ForEx, also editor of the Mark II Market website. Marc, we usually feature you on our special Sunday editorials to recap economic data and look ahead to the next week. I wanted to feature you on this weekend show because, well, we had some important inflation data out of the U.S. We also had Fed minutes, and we had some rumblings in China when they came back from their golden week. So let's start off with the inflation data. We had PPI and CPI released this week, broadly in line to a little bit higher than expectations. We really seem to have, at least in my eyes, seen a leveling off of inflation here above the Fed's target rate. It's not skyrocketing, but also that downward trend seems to have moderated, if not stopped. So, Marc, what was your takeaway from the inflation data this week?
Yeah, I think that we saw that the headline rose about 0.2%, slightly more than expected. But if we're going to get to 2%, that's what we need is these 1 to 2% a month readings, more than 1%, 0.1% reading. But I think what bothered people was that the core rate picked up. That is, the year-over-year rate went to 3.3% from 3.2%, while the headline rate still fell. We made a new low for the move down to 2.4%, but the core rate, 3.3%, slightly higher than expected, a little bit higher than in August. And this is, for me, this is really, like I was saying before, like part of the 1-2 punch. Stronger than expected U.S. jobs data last Friday, the 4th, and then this week, a bit firmer than expected CPI, PPI. This is what's really has been a real key driver, not so much to the equity market per se, but to the other parts of the capital markets. And what I'm thinking there is the higher U.S. interest rates and steeper U.S. yield curve and generally stronger U.S. dollar. So higher rates, I think, in the U.S. My own guess here is that we're exaggerating what's going on a little bit. And I think that's really the takeaway from some of the Fed official comments. It seems to me that the market, which had been leaning towards 75 basis point cuts here in Q4 before the jobs data, had to readjust. It was really a question of market positioning. But the Federal Reserve, I thought, took it pretty much in stride. We've seen several officials speak since the FOMC meeting. We had those FOMC minutes, and I think that the takeaway there is that the greater disagreement, the greater discussion, debate about whether the Fed was going to go 25 or 50, and ultimately I think it's Powell's role as chair that really drove the decision to do 50 basis points. And remember, we talked about this last week as well. It looked like somebody, probably Powell, planted a story in the media to help prepare the markets for a 50 basis point cut when the CPI that had triggered the move took place during the quiet period when the Fed isn't supposed to be talking to the press ahead of the meetings. So bottom line here is I think that the CPI on the heels of the jobs data made the market pull back and think again and converge again with the Federal Reserve as far as rate cuts this year. The median dots in September pointed to 2 quarter-point cuts, and I think that's really where the market is. The market's just below there now, and I think that's where we're sort of settling at.
Yeah, Mark, I think that's what's really important from all this economic data is what is the central bank policy going to be? How is the Fed going to react? And there has been a lot of Fed heads out, discussing maybe different angles. Some even said that they were fine if we only did one more 25 basis point hike. And just a couple of weeks ago, the market was still pricing in the potential for a 50 basis point hike at one of the next two meetings. So now it's gone from 50 to 25 to possibly two 25s or maybe just 125. And it brings up the larger question of this market has also been pricing in rate cuts all through next year, pretty much. And it's the same thing we saw in previous years where they were looking forward to this year expecting seven cuts, and we've so far only gotten one. So what does it mean if inflation stays stickier, if the jobs, continue to trend the way they have? Could that derail the market expectations for this series of rate hikes? And may the Fed just take their time and not be in a hurry, keep some bullets in the chamber?
Yes, I suppose the Fed could be patient. That's what they've signaled. I'm not so sure if I'd say that the seven rate cuts. But to me, it's a moving picture. It's like a video streaming and taking one part of it and making a snapshot. I'm not sure if that's a fair reflection of what the market really thought, though it was at one point in time it did have those big cuts in. But I think that the market really agrees with what Powell has said, and that is that inflation's decline this year is more important than last year because it's broader. That is, it's covering more sectors. But I think you're right. I think that I think we might have talked about this a bit last week too. That the debate has been between a soft landing and a hard landing, and this one number, non-farm payrolls last month, so that'd be for September, has made the market renew this like speculation that maybe we have no landing. But right now, when I look at the Fed funds futures, I see about 150 basis points of cuts priced in, which is more or less what the Fed had in their dot plot. And the reason that people look for lower rates, even if you think that the economy is not going to have much of a landing, but we could stay around these types of levels, is that the level of policy, when it was set at 5.5%, it was meant to address an overheating economy. Even if the economy stabilizes at these levels, it doesn't seem to be overheating like it was. So the level of restriction is not needed. When inflation's at 7% and you raise the Fed funds rate to 5.5%, that's one thing. But inflation is well below there now. So the real rate, and it's sort of the I want to say naive sense of a real rate, you just subtract CPI from the nominal interest rate, and that gives you a proxy for a real rate. And real rates are high. And so I think what the Fed wants to do is, if the Fed, I think, is committed to trying to engineer extending the soft landing that we're having, and to do so requires lower interest rates. So I think that the two cuts for the remainder of this year still seems to me to be the odds-on favorite. And the market's got 45 basis points at a possible 50, say, priced in. And that gives us another 100 for next year. I think that seems to be reasonable based on our current information set. But I think you're right, too, Chad, that not only does the market not get it right, but policymakers don't get it right. The economists don't get it right. The economy perhaps is as difficult as trying to forecast the weather, an unstable, nonlinear system. And so I think that we always have to make these attempts. And even though we should be humble in that, I think we have to think about what the future is going to be, even if we don't know, and even if we're often wrong.
Mark, because so much focus is on the jobs market and inflation. Look, the jobs market has been weakening, but the last report was fairly strong. That's going to be revised a few times, so who knows where that comes in. But on the inflation front, there's a lot of people out there saying that the inflation fight is not won. We're not down to that 2% level. A lot of people are saying that inflation could spike back up, and so many different factors play into inflation, whether it's central bank money printing, monetary policy, also trade and the flow of goods as well as labor costs. So many things play into this. Where do you see the risk of inflation picking back up to the upside?
Yeah, so inflation picking back up to the upside. So first, I want to say that if we take the last 3 months of inflation and annualize it, so it's about 2.4%, which speaks to exactly what you're saying, that we're not quite at the inflation target yet. And so where could inflation come from? A new, stronger surge in economic activity could boost it. I think that what a lot of us are looking at is thinking about the correlation between oil prices and the 10-year break even. So the 10-year break even, remember, is sort of the inflation expectation derived from subtracting the nominal yield from the 10-year tips. And that break even, it tends to be correlated with the price of oil. So as oil prices have gone up, fueling inflation expectations. And so I think that why is oil going up? I think there's three big stories I think for it. One is, of course, the widening conflict in the Middle East and the potential for Israel to retaliate, perhaps hitting Iranian energy capacity, oil, or the refiners. Secondly, China has given us a big stimulus package. We'll find out more on the 12th, but the large stimulus package might be worth, some people think, say 0.5% to GDP, maybe a full percentage point to GDP. Some of that would be this year. And so that would be boosting demand from the world's second biggest economy. And the third source, I think, is just here in the US, where the Fed's 50 basis point rate cut has helped sort of underpin what people expect to be stronger demand. So I think these three factors, which say nothing really about inflation or general economic activity, but I think that's really the point, is higher oil prices could be one of those shocks for inflation. In my understanding, the Fed sees higher oil prices as a tax on consumers. And what that means is the more it takes to heat up your house or to fill your car with gasoline, the less you have on discretionary spending. And so higher price of oil has tended to be, we tend to get an oil shock before we get the economic downturn. And that's why I'm watching oil carefully. We're still firm here near $75 for the November WTI. I think we go above 80, and then I think will get people more concerned about this energy shock again.
Yeah, Mark, you don't want to see those higher energy prices because it's not just a tax on citizens and consumers, it's a tax on businesses too. It makes freight more, shipping anything around the world becomes more, manufacturing becomes more, and a lot of products use petroleum in their end products. So it's definitely not great for keeping prices low. But the other factor you brought up there was the China factor. They've been very vocal coming out of Golden Week with, and even before that, honestly, with what their initiatives were going to be to help boost their real estate markets. And they've been doing a lot of easing, but not really calling it easing on a monetary level. And I think people want to see more fiscal involvement. What is the government going to do? And there is a big address coming up really over the weekend. What do you make of some of the policies from China and how global markets are reacting in what's been a really dicey week in the Chinese markets?
Yeah, China is so interesting, huh? I mean, what I find most interesting, I think, is that when observers look at China, I think that we see China through a lens of their ideology, and I think that confuses the situation. Listen to what the Chinese premier said earlier this week. He was quoted on the newswires, vowing to, quote, listen to the voice of the markets when setting policy. Does that sound like a communist, or does that sound like a capitalist? I kind of think it sounds like what policymakers in the US or Western Europe or Japan or Australia or Canada themselves might have said at some point. And so I think that what's happened is that there's a huge rally in Chinese stocks spurred by that stimulus package at the end of September, when the Chinese markets opened up again from taking that week holiday celebrating the National Foundation. The CSI 300 rose 6% on October 8th. And this was the 10th consecutive daily rally for the CSI 300. Over that 10-day run, 35% rally. So in the past three sessions, it's fallen 9%. So people say, oh, this is the lack of confidence. I think it's partly lack of confidence, but it's also partly just pure profit taking. Stock market goes up 35% in 10 days and then falls 9. So I'm not so sure that this is the end of the story. I think you're right that China very well could announce more fiscal measures over the weekend. That's why I mentioned that there's some talk of as much as 2 trillion RMB, some of around 240, $250 billion. I think you're right. I think that people want to see fiscal policy being used. And this would be, the idea is that monetary policy is really more of a supply side function, while fiscal policy would be more of a demand on, it would help foster demand, which many critics think is a missing link in China's story.
So how does this China policy filter through to markets, especially US markets or even commodities? Because we do see China really moving the market for commodities on a regular basis.
Yeah, I think you're right. I think that would be a real litmus test for it. I'd be watching iron ore prices for the steel. I'd be watching copper and aluminum, but also I'd be watching in the oil because China is the world's biggest importer of oil. But yeah, I think commodities is part of the story. If you're optimistic on what China is doing, rather than buying Chinese stocks, you buy the commodities. In the foreign exchange market, the Australian dollar is sort of regarded as almost a proxy, a G10 proxy for China. The Aussie is closing well this week. It's closing near its highs. And I think that the China story is part of the reason it's helped it recover.
Well, Mark, let's dive into the currencies a little bit more. You're kind of our resident currency expert. So, what are you seeing as far as trends in the dollar? Also, you had mentioned some interesting comments off mic about the Canadian dollar kind of tracking the oil price movement and even the big central bank meeting over in Europe. So, let's get a review of the currencies.
Yeah, sure. So I think that the story really begins in August. The dollar began selling off, lasted through most of September. We're bouncing. We've been really bouncing more or less since late September, early October. This past week, some of the major currencies tested important levels. 109 in the euro. In sterling, we got close to 130. In the Aussie, we got close to 67 cents. In the Canadian dollar, we've approached 138. And these levels so far are holding. And I think it's mostly corrective in nature, helped, of course, by the higher U.S. interest rates, which helped fuel this correction. But I was looking for the correction before we got the higher interest rates, just because of how far the dollar had fallen. I was looking at the 112 level in the euro. The euro had traded a couple of times, and I was looking at the 2-year interest rate differential, which the U.S. pays a big premium over Germany, but that premium had been falling. And I find it's not so much a one-for-one level of the premium to the euro, but really the direction that interest rate differential is moving. And I saw that interest rate differential beginning to move back in the dollar's favor. And so I felt confident that 112 area was going to more or less hold. But now, that the euro has fallen 3 cents from its high, a little bit more than 3 cents, that the interest rate differential is beginning to narrow again. And so I suspect that if we haven't bottomed yet in the euro at 109, we've come pretty close to it. Sterling's been an amazing currency too. It's really been the strongest currency of the year in the G10. But we held that 130 level. We need to get above 131, 131.20 to really confirm that it bottoms in place. And of course, as you mentioned, the Canadian dollar has really been like out of favor. So far out of favor, I want to say that the Canadian dollar, the pressure on the Canadian dollar has been relentless. And by relentless, I mean that the Canadian dollar has sold off now. This is today, Friday the 11th, is the 8th consecutive down day for the Canadian dollar. And today we had Canada reported very strong, I should say, jobs report. On the headline, they created 112,000 full-time positions, and the unemployment rate unexpectedly fell to 6.5%. But the Canadian dollar hasn't got much traction, and its losses were extended. And so what drives the Canadian dollar? Usually I see the Canadian dollar being a proxy for risk. So I see it being correlated with the S&P 500. Sometimes I see it a broad US dollar move, so the correlation is sometimes greater with the dollar index. But in the past couple of weeks, past month or so really, that correlation is broken down. So it tells me that breakdown of correlations with these other factors just suggests to me that there's something idiosyncratic about Canada right now. And two things come to mind in politics. That sort of sums it up in one word. Both Canada's politics, where the Canadian minority government might not last another month if they don't pass reforms that the Bloc Québécois want. Otherwise, they'll support the Conservatives' no confidence vote. On the other hand, in the U.S., we're less than a month away from our election. And as people study the Trump's tariff proposals and they try to work through who is helped and who is hurt, Canada, the countries that are closest to the U.S., and I don't mean geographically, though that's true as well, but really in trade ties, get hurt the most. That'd be Mexico and Canada. And so I think that these political factors, in addition to the idea that Canada might be the next G10 central bank to cut rates 50 basis points. The Fed has cut 50. New Zealand this week cut 50 basis points. And Bank of Canada Governor Macklem had suggested they could accelerate their cuts. And it's really a question, really, I think now, the employment data would say that they don't need to cut rates by 50 basis points, at least on the headline cut numbers, the decline in unemployment rate. But next week, next Tuesday, the 15th, Canada reports the CPI, and that'll be the key. The headline looks like it's going to soften below 2%. But for the Bank of Canada, the core rate, the underlying core rates are more important, and those look a bit sticky.
Okay. Thanks for that recap there, Mark. Look, we're in this trend of central banks cutting rates, and now it just continues to be, I guess, that debate of 25 basis points or 50 basis points, and the Fed, I guess, trying to push off some of those expectations. But look, we're in a rate cutting cycle here. Let's quickly recap the markets this week because, look, all the averages were up this week. The S&P, as we're recording this, is over 5,800. The NASDAQ was up this week. Russell was also up, but that broadly still lagging, I guess, the NASDAQ. Overall, what do you think is causing this continued strength in U.S. markets when we're in a seasonal time when usually markets are weak? We have the VIX that is still remaining in the 20s, which is generally elevated for where it has been for the earlier this year. What's driving the continued strength in U.S. markets?
Well, yeah, it's interesting, huh? Because we're at record highs still in the U.S. But at least in the past week, I don't know if the U.S. has really outperformed. Give me a sense of this. The NASDAQ is up about 1%. Canada is up about 1.25%. Germany, which has had a horrible factory orders report, though a better industrial output report, up 1.3%. Italy is up over 2%. The Nikkei is up 2.5%. So to me, this is more or less a global rally, a global phenomenon. And what's driving, I think, is, like you say, we know the direction of travel. Central banks are cutting rates. And in fact, something I just hinted at before, and that's that the European Central Bank, the ECB, is likely to cut rates as well next week. But what's interesting there is they cut rates in September. People didn't have a strong chance of a back-to-back cut. But then the Eurozone reported the CPI fell below 2%. So we talk about the U.S. not reaching its 2% inflation target yet. The ECB is there. I suspect that we'll get the Bank of Canada there next week as well. And of course, China's been there for a long time. Japan's a little bit above there. The UK has tested that area. So the US is, in some ways, the higher inflation out of the say G5 or so. But I think you're right. Global equities, I think, like the idea of lower interest rates and what looks like a soft landing.
All right, Mark, always great chatting with you. Thank you again for taking us through recapping the data this week and looking ahead to what we all should be watching and what the markets will be moving on in the next week. Look, Marc Chandler, managing partner at Bannockburn Global ForEx, also editor of the Mark to Market website. Click that link in the show notes to follow along with Mark's pretty much daily commentary on key data and market moves. Mark, it's great having you on the show. I hope you have a great rest of your weekend.
Thank you. Good luck to everybody.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, now shifting our focus pretty much exclusively to the resource sectors. We are chatting with Joe Mazumdar, editor of Exploration Insights. Click the link in the show notes to visit the Exploration Insights website and follow along with Joe's site visits and the companies he is writing up on. Joe, we're going to go back a little while now to that Beaver Creek conference, and a comment you made to us before recording here is that you noticed the excitement around critical minerals had come down quite a bit. It's moderated. Now, in all fairness, I think a lot of the resource investors have now just shifted their attention back to gold, but that whole story around critical minerals and the electrification build out was all about this supply demand imbalance because of how much more of these metals we need to build out this infrastructure. We're seeing this transition happen slowly, which I think we all kind of expected to happen. But again, investors are distracted. Critical minerals companies are struggling broadly, although we did see a big M&A transaction announced this week. Joe, what's your thought now on, I guess, the health of the overall critical minerals sector, especially when it comes to these companies that just aren't getting the same attention they were, let's say, last year?
Yeah, I mean, I guess the peak of it was it last year or when I was in Quebec for a conference? Quebec was all about lithium. The Australians had come over, they were developing their, hard rock lithium projects in Western Australia. And then they found that there was just as much potential in Quebec. And they brought the money and they brought the expertise. And then suddenly the Canadian companies started doing their own lithium again, because obviously we remember the Nemaska failure and people were burnt by lithium at that time. But, these companies were generating big valuations. They were raising a lot of money. And I remember clearly there was a company that had, outcropping lithium up in the Northwest Territories that had a market cap of about 350 million without drilling a hole. That was the peak in terms of sentiment. That price and that sentiment obviously has come down quite a bit. Nickel, we had the issue with the Indonesians and the Chinese pumping out a lot of very low cost, environmentally not friendly nickel out of Indonesia that pushed the cost curve down such that a lot of the projects in Western Australia, I saw mine in Tasmania when I was there, that was shut down, and makes most of the projects in Canada, they're not viable under that price level. So the problem right now is that there's no incentive for these projects to be built to go into this potential demand for EVs. Let's just talk about EVs right now, but for the batteries. And because the US that can fund a lot of these projects, they can give you cheap debt, they can give you grants, but they can't change the nickel or the lithium price. So even if you get cheap debt, your ability to pay it back at these prices is very low because you're not going to make any money. So that's the dynamic. And then at the same time, on the EV demand side, we have the penetration in the States, even in California, not as high as people expected. The infrastructure is not being built out. The cars are too expensive. We don't allow the cheaper Chinese vehicles in because we want to decouple from the second largest economy in the world. And so there's not a lot of demand for these EVs. People are worried about the depreciation of them. They're worried about what they do with the battery once the car is done. And so all those dynamics are different for an EV versus internal combustion engine. So I think the hybrid, which was supposed to be a transition, has come back in vogue because you don't require the infrastructure. You still get some of the, a reduction of carbon emissions, but also the vehicles, there's more to choose from and they're better sort of cost level for people to enter. So I think all of those dynamics have impacted sentiment, their ability to finance, and the discussion around critical minerals, specifically the ones that are filling the EV batteries.
Yeah, Joe, and I think we've seen a lot of the major automakers announce that they are switching back to more of a hybrid focus just in their production lineups of the vehicles. So all that has kind of played into this rotating cast of characters in the minerals, in the critical minerals, where you saw cobalt jump up and then jump back down a couple of years ago. We've seen constant waves of rare earths pop up and down. We did have the big nickel spike and then the drop, the lithium spike and then the drop. But now we're seeing a new one rear its head, Joe, and that's antimony. A lot of people are focused on ESG and government funding that critical minerals allows, which is a big positive. And there's been a couple of big announcements recently. Mandalay Resources really has always had some antimony, but is now pushing it a little bit more. Skeena Resources has some antimony credits that are getting interest from Chinese smelters, and they were discussing that in Beaver Creek. And now we've seen the big deal with Perpetua Resources where they got their big permit to be able to develop a project that has both precious metals and antimony as well. Maybe talk to us about that metal, antimony, why it's buzzing right now, and your thoughts on it being standalone versus paired with a precious metals company.
Yeah, I mean, I don't know if there's many or if any, standalone antimony deposits. They usually show up as byproducts. And Mandalay, obviously, that's this, quote unquote, epizonal style of deposit that's Fosterville-like, smaller gold antimony in Victoria of Australia. And that's been producing for a while. But obviously, yeah, they produce gold, and I believe mostly the gold is in a antimony concentrate, and that mostly was going to China. There's another plant that I think that's in Oman that's been recently shut down. But yeah, the problem is that they would have to probably look for a different smelter if all their antimony is going to China, and then China has effectively banned the export of antimony. And that's where the buzz is, and that's what we have the spike about antimony. The idea behind antimony and companies like Perpetua, they were talking about that about 3 or 4 years ago, I believe, at Beaver Creek. They were talking about critical minerals, and they were talking about antimony. Even though antimony is still a byproduct for them, probably less than 10% of their in situ revenue is antimony. But if you could talk about antimony and the US government wants that antimony, and you could get 70% of your upfront capital, which is significant, because this is a $1 billion plus project to build, that's huge. I mean, there's not a lot of projects that, can use their byproduct credit not only as a reduction in their cash costs, but also a big reduction in their cost of capital to build the project. And so that antimony is a byproduct, as a not necessarily as a must-have, but an interesting addition to your revenue, even more now, is very important, because not only does it impact your revenue or your cost if it's a byproduct, but also now it's impacting your cost of capital in terms of actually getting funding.
Joe, let's talk about China's role then in this whole EV space. Another thing you brought up off mic was the fact that, look, China does pretty much all the processing of these metals. So as much as the Western world wants to say we want to separate from China, we want to grow our own infrastructure, we still need to process whatever we pull out of the ground. So where are the investment opportunities with all the build out that the Western world still needs?
Yeah, I believe that most of critical minerals is less about the mining of it and more about the processing of it. And unfortunately, for those people that want to decouple from China, most of that processing has been built up over the last few decades in China. Hard to replace in less than a decade into the West, whether it be Europe or the Americas. And I think what the US is trying to do is look for spots that they think that they could build out the infrastructure in that's easier to permit. And I could tell you a lot of the countries I travel to are wary of that idea, that, hey, you don't want to build it in your country, but you're coming to my country because you think it's going to be easier to do it here. And, all the environmental damage and blah, 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 I have to eat it. So there is that little bit of animosity towards that kind of idea, but that's where the U.S. is going. They're building infrastructure like, we talk about the Lobito Railway to try and get copper from the Central African Copper Belt of the DRC and Zambia out west through Angola. And they'll probably look at building up smelting capacity in that in other places where it's less difficult to permit, because they still have these issues with permitting, not only mines, but processing facilities. So that's the dynamic that the U.S. has to deal with. And, they're almost their worst enemy with respect to proposing the ESG, wanting all these metals, but not wanting to mine them and not wanting to process them in their own country.
Well, Joe, let's also weave copper into this discussion, because some countries it's considered a critical mineral, other ones it's a strategic metal. But any way you look at it, not just the EV narrative, but if you look at AI data centers, if you look at just the developing world growth, the need for electricity, the problem with the energy transition is you need energy transmission, and copper is the conduit for that. What's your outlook on the copper market?
Well, I was always very positive on the copper market just for that reason, that it's more about the infrastructure of anything related to electrification, whether it be your car or solar panels or whatever, the infrastructure would require copper. And so I wasn't that worried about the demand scenario for copper being too linked to EV penetration because it also is more intense in a hybrid than it is in an ICE vehicle. So that intensity goes up even with a hybrid. But all those other technologies as well for power and electricity obviously need copper. And then for me, the bigger issue as well is the supply scenario. Because as we know that 50% of the smelting capacity is in China, but they don't have the mines. The mines are everywhere else. So whether it's Chile, Peru, the DRC, a lot of these mines, the new mines to replace the old mines that are aging in places like Chile that have to be replaced are hard to find, hard to permit, and hard to finance because they're much more expensive than we thought. And so that's why a lot of the M&A is more on production than it is on building, because these companies are convinced that, it's going to be more expensive to build and buy. They're willing to pay that premium for production. But in the end, eventually they're going to have to start building new projects. I mean, these expansions that we talk about, brownfield expansions that people expect to be cheaper, are not cheaper because they're bigger than an expansion. It's not quite a greenfield project, but it's a total change in the mine. Much bigger milling capacity, much higher throughput, treating lower grade that requires more water, a bigger desalination plant, more piping infrastructure, potentially a bigger port for a bigger boat, and then more power as well. All of that, off-site ancillary infrastructure costs money. And especially when you're, got a semi-remote project or a remote project. So that's the fear that a lot of companies have. And they're not convinced even at 450, that's enough to generate a decent return on some of these projects.
So, Joe, what about looking further down the food chain then? You're right. A lot of attention has been on these developed assets that have been around for a little while. Needs a lot of capital to build, but they can make money for decades. We all know how tough the junior market has been, and quite frankly, it only gets more expensive for the juniors to drill. And drilling out copper assets is very difficult and expensive. But that being said, we keep on hearing how there's a lack of discovery, not just in copper, in a lot of metals, but copper being one, a lack of major discoveries. Do you think there's any chance for these juniors to get off the mat, raise the money needed to actually grow a resource that will finally be a takeover target?
Yeah, I mean, we talk about the lack of discovery, and I think that's correct. But some of these projects that were discovered and have resources or even reserves are not being built because of permitting issues, whether it's Pebble, Rosemont in Arizona, and there are a number of other projects that have water issues and, whatever, that can't be built. And such that, companies like Barrick, a gold company that wants more copper exposure, they're expanding their Lumwana project in Zambia, and they're building a big copper gold project in Pakistan. So in terms of exploration, when people have made money, they go back to the same trough. And so where Filo did really well, they were drilling these big, deep holes that are very expensive, more than $1 million to drill each hole. Then suddenly somebody who's made money off of that doesn't mind funding somebody else to do the same thing. But then when you fund a junior to do that, you give them $5 million, that might be for 5 holes, and then if they don't hit anything, they're going back to the financing trough again to look for that kind of money. And people are going to, eventually get tired of giving them money for not only a short field season, but not much of a drill program because you only get 5 holes every time. So, drilling copper is bigger. It's not as easy as gold because you're trying to delineate something much bigger. And, some of these remote projects are expensive to drill. And in the end, a lot of copper exploration was not funded by retail like more than 3 years ago. Retail is more interested in funding copper. But the problem is that retail is still a short wave investor. Exploration is still more of a long wave investment. And so these companies need, I believe, the majors to come in and help them and do these earn-ins such that if they don't hit anything, they're still drilling. If they drill a hole and they get really good alteration, they don't have to go back to the financing trough and explain that to retail. They can explain that to the major, and the major gets it. The major also would fund deep geophysics that, because a lot of this stuff's undercover, that retail may not pay for. So I think a lot of that kind of exploration has to be funded by majors because they have a more long-term investment scenario.
Yeah, such a good point, Joe, because a lot of the retail audience, like you say, they're short wave. They don't care about the surveys that are needed to do the deep targeting, and they may not be able to pony up round after round of financing where the major can maybe partner with them over multiple drill programs and give it a second and third wave of drilling to really test the thesis. I have a question for you, though, because I love how you look at development stage companies and who could be the takeover targets. And I wonder if, as an industry, we're using the wrong kind of model, using the discounted cash flow model that you would use on a gold company for 10 years on projects that are 2, 3, 4 decade-long mine lives. And so when people dissect the economic studies on copper projects, they're often disappointed that the IRR is only 16% or 20%, and they're used to those juicier numbers from gold. But these are a lot longer life assets. Are we as an industry valuing these copper projects unfairly?
Absolutely. So when I worked for Newmont, I used to work on the capital projects. One of them was Conga, which was a big copper gold porphyry. And, no matter what I did, I mean, the copper price went up, our capital costs went up, the return would never be better than 12%. But what people got to understand is when companies look at assets, they want this base of production that's multi-decade, and they're willing to pay for that. And so when and this guy, one of the treasurers, he worked in treasury for Newmont, we built this rate and rank model. He's now a prof actually at Colorado School of Mines where I went. We built the model. We tried to add in that dynamic that it's not only NPV, it's not only IRR, it's not only payback. We entered a category for mine life. We entered a category for size of the prize as well with the reserves and stuff like that. So that's definitely what people think. But when you only value by NPV, IRR, and payback, you won't get that. And then you'll rate and rank incorrectly. And then you'll wonder why this project was purchased and this one wasn't. The long life is a huge thing that was not that important for gold companies maybe plus 10 years or more ago, but now has become more important when they're looking for long-lived assets. And it's hard to do that when most gold assets have a life of 8 to 10 years. And the only way you can get the 20 plus is to do porphyries. And porphyries on an NPV model don't look so good.
So I think we'd all like to see these companies valued higher, but the end buyer, the majors that need to buy these to give it that higher valuation, are they in any rush in your eyes to buy these assets then? Because right now, at least we have a few more companies looking into copper, some of the major gold miners, but they're the ones that need to put the end value on these assets when they buy them out.
Yeah, so what we like theoretically and our stretch goal is to have the market value fully these companies that have the development projects or exploration projects, whatever. And then the major comes off and gives us like a 20 or 30% premium on top of a full value. That's what we'd love. What's not happening is that a lot of these companies are not getting valued like that. And so when the premium does come, it may look like a nice fat premium, but it's coming off of a much lower base because the retail sector is not valuing the size of the deposit, where we are in the, infrastructurally, the power, maybe access to water, all these things that a major would look at, the social license to operate, that might compensate for another project that might be higher grade, the quality of the concentrate, all that factors into which projects get bought and which projects don't get bought.
Well, Joe, speaking of projects that get bought and don't get bought, we have seen some M&A action heat up in the silver space, so I want to weave that into the discussion as well. We've seen two big transactions recently where First Majestic recently took over Gato Silver, a large single asset high grade producer, to bolt onto their operations. And then also just very recently, we've seen the Silvercrest takeover by Core Mining, again, bolting on another high margin, low cost operation, high grade, both in Mexico. I guess it weaves into the discussion both the M&A cycle, but also the desire for companies to still operate in Mexico.
Yeah, okay. If we disentangle this thing, let's start with Mexico. Sheinbaum became president, first woman president, which is great. But I think some people are convinced that she will slowly, maybe over the next year, sort of disengage from AMLO's rhetoric and then take her own path. That is the ambition of many in Mexico that hopefully see an upside to this. My problem is that the super majority that Morena party, which she's the leader of right now, well, she's the president on behalf of Morena. She's not the leader of the party. It's still AMLO. That super majority was him, not her. I'm not unconvinced that he could have put a fire hydrant there and they would have got a super majority. So I'm not sure how far she can travel away from AMLO in terms of policy. I mean, as I've said previously in other podcasts and other interviews, is that the big thing for Mexico is nearshoring. They see a window opportunity to bring that manufacturing that left in the early part of this century back to Mexico. They can never replace China, but that is what's going to really stretch their economy and grow their economy. And that's what her focus is and probably should be. The mining is a very secondary or tertiary thing for her. So when people say, oh, she's turned around on mining and thinks mining is very important, I don't know if she thinks mining is very important for growth. I really don't, because they're on a different path. And they can make that path, make the Mexican economy stronger without requiring mining projects, which may hurt her with respect to AMLO, who was the one that originally proposed the ban on open pits. And basically, let's not forget, even doing grassroots exploration, getting new tenements and all those concessions, that's been dead since the time of AMLO and has not been resurrected.
Yeah, that's a good point, Joe. But back to kind of that M&A, Silvercrest, Gatos, these are assets that were making money. They are advanced assets, and that seems to be, again, still the focus of M&A. So with this maybe lack of interest in mining, not a complete disregard for mining in Mexico, and so much silver mining and silver projects in Mexico, what does that mean for the investment landscape in your eyes for silver stocks in Mexico?
So the important thing was that if we look at the suitors, and then we'll take a look at the targets. So the suitors, one, First Majestic made a disastrous acquisition with Jarrett Canyon. That's not made money. It's actually drained what cash flow they were producing from Santa Elena and San Dimas into that money pit, which is Jarrett Canyon. And so, year to date, before the transaction was announced, they were almost flat. And this is a highly levered company that spends a lot of money on investor relations and touring the world and talking about silver. And, their share price wasn't doing very well. So, the whole idea with First Majestic is it's one metal, which was silver, and one country, which is Mexico. And then they went to Nevada and looked at gold. And so I think they're coming back to their roots. That's generating free cash flow. And, post acquisition, First Majestic has done as well as Gato. And so that's probably a win for both. And understandably, they use paper because they don't have the money to buy anything. Gato's silver shareholders are happy that they got over the resource and reserve issue, the problems with the operations. They'd had a nice turnaround. I think Electrum funds wanted an exit. They got their exit and now own shares of a more liquid company, which is another big deal here is the liquidity of the suitor. And they can sell out of First Majestic, So that's one transaction. And in terms of the target, underground already in production, so the social license to operate is there. No capital required in terms of upfront capital, just sustaining capital that free cash flow will pay for. And so it's running. And so you're paying for an operation. Gato silver share price still did better than First Majestic's year to date. So they didn't have that ability to say, hey, my paper's worth more than yours. Gato actually did better than they did. But I think First Majestic were in a bit of a corner with respect to their shareholders to say, hey, silver's going up, but you've actually added gold exposure and this thing's a money pit. What are you going to do about it? So I think that was their solution. And, according to their share price, it was looked on well. Take the next one, Coeur. Coeur has an incredible share price appreciation year to date, more than doubled. compared to Silvercrest, which is high margin, they always were very well valued, but they'd gone up maybe 40 to 50% year to date before the transaction. So in terms of share price appreciation, Coor's paper was worth more. Coor had spent a lot of money on the Rochester expansion. They'd taken on a lot of debt, and so free cash flow wise, they weren't in a good position. Not in a good position to pay back their debt. So balance sheet was a big issue, and their inability with the current assets to repay that in a decent way. So now what they're doing is saying, as opposed to going to the market and raising capital based on the increase in my share price, why don't I just use my paper to buy cash flow, which is basically what they did. Again, Underground, Mexico, both First Majestic and Coor have assets in Mexico. And they've gone for Underground, operating, social license to operate, all that sort of stuff, and generating free cash flow. Both transactions make sense for each suitor. What would interest me with respect to Mexico is does somebody come in from outside and buy a development asset that's not in Mexico right now? That would be a good sign for Mexico if that happened. Another over the moon sign would be if somebody came in and did what Agnico did several years ago and paid $500 million to go into a joint venture on a big open pit. That would be ridiculous if that happened. That would be a real boon for Mexico. That hasn't happened either. So those are the signs I'd watch if you're interested in seeing, how Sheinbaum diverts from AMLO, or if she does.
Well, Joe, just bringing up silver developers, there are some people looking further afield from Mexico now, and there are other projects in Argentina, in Peru, in Chile. There's other silver projects in the Golden Triangle. You've got some in Ontario. You've got some in Nevada. Do you think that other jurisdictions are going to start getting a premium for development stage silver projects?
Well, I definitely think that they'll get a more of an intense look. So before, when Mexico was good and, you could develop there, and they were, it's the biggest producer of silver in the world as a country. The biggest silver mines are still, base metal mines. So when they were good, then looking farther afield, like Peru was also a big producer of silver. But at that time, it was harder to permit, potentially more social license to operate issues. Argentina wasn't thought of very much. It was more of a byproduct from the Patagonian gold assets. And Chile, Cerro Bayo, El Peñón had silver in it. Cerro Bayo had that issue with Mandalay and an accident. Now that's being looked at more intensely by a new ASX-listed company. The Salta province, Abra Silver. And now this new one that Justra's leading called Argenta, I think Silver. That's being looked at. And Peru, the permitting, backlog is making its way through. So my next big trip to South America will be to look at several silver projects down there in Peru and Chile. I've already gone down to Argentina back in, was it July or August, to look at a silver project up there, which was Abra Silver, which I own shares of. So yeah, I think what's happening in Mexico has driven people that are silver focused or want to be silver focused outside of Mexico.
All right, Joe, before we get you out of here then, before we wrap up the weekend show, look, there's a lot of opportunities that I think we continue to see in the resource sector. We've talked about a lot of M&A, and yeah, we've had a pullback and some excitement around critical minerals, but that's because a lot of that money, I think, has gone to more of the precious metals stocks. Copper continues to be talked about widely, but broadly, we can say that the juniors are continuing to struggle no matter what metal they are in, except for a handful of stocks. I know it's very nuanced, but Joe, where are some of the best opportunities in your eyes for investors to capture this interest that is in the resource sector? It seems like we're in a bull market, so where should investors be looking?
Well, I mean, right now, if the M&A is important, production will be bought first. But what we're also seeing is divestitures. And so like the Newmonts aren't going to be buying anymore because right now they're trying to shed some fat. And so you saw, I think it was yesterday, they sold, I believe it was a Chim or a Hafel, one of their Ghanaian mines. They sold to, I think it was a Chim actually, to Zijin for $1 billion. So we're going to see some of the M&A being on some of these divestitures of Newmont's assets that people are waiting for to see if hey, do I buy this one that's already in operation or buy this other one? So that might be holding back some of the discussions with M&A in the gold sector. So, wait and watch on that. I think silver is one that's taking more of a spotlight because of the issues with Mexico and because silver has now outperformed gold year to date. And are we going to see more compression of the gold to silver ratio, which I think around is now about 83 or something like that? Is it going to get, to below 80? Is it going to head to the mid 70s? That could torque silver. The copper is going to be on the M&A, will be about production, but there'll be a window for development that will start getting acquired. And we saw a little bit of that with Lundin and BHP and Filo. But, I'm thinking that we got to see some of these other projects as they get permitted, which will be an important milestone, start to get acquired.
Okay. Joe, always great chatting with you. Again, Joe Mazumdar, editor of Exploration Insights. Click that link in the show notes to follow along with all the companies Joe is following and his thoughts on the markets. Joe, it's a pleasure having you on the show, and everyone, thank you for tuning into this weekend show. Please be sure to go back through our website, kereport.com, or search for our podcast in your podcast player under The KE Report to listen to all our daily editorials and company interviews from this last week. I hope you all have a great rest of your weekend. Thanks for tuning in, everyone.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.